Investing can feel overwhelming for someone with no prior experience. From stocks and bonds to mutual funds and cryptocurrencies, the financial world seems filled with complex jargon and risky decisions. Yet, investing is one of the most effective ways to grow your wealth over time. The sooner you start, even with limited knowledge, the more time your money has to compound and grow. Investing doesn't require expertise at the beginning. It requires consistency, discipline, and a willingness to learn. Today, we will talk about how to start investing with no experience. So before we start, make sure to hit the like button and subscribe to my channel. Step 1. Understand the basics of investing. A beginner's first step is understanding what investing really means. At its core, investing is putting your money into assets that can grow in value or generate income. Stocks, bonds, ETFs, mutual funds, real estate, and even emerging assets like cryptocurrencies all represent different ways to invest. For example, owning stocks gives you partial ownership of a company. Bonds allow you to lend money to governments or corporations in exchange for interest. Mutual funds and ETFs pool money from multiple investors to create diversified portfolios managed by professionals. Understanding the basics of risk, return, liquidity, and time horizon is essential. Investing is not gambling. Educated, consistent choices over time significantly improve your chances of growing wealth. Step 2. Set clear financial goals. Goal setting is critical in investing. Without clear objectives, your investment decisions can become scattered or reactionary. Define whether you are investing for retirement, buying a home, starting a business, or building passive income. Short-term goals, such as saving for a vacation or emergency fund, are better suited to safer investments like savings accounts, CDs, or short-term bonds. Long-term goals, such as retirement or wealth accumulation, allow for higher risk assets like stocks or ETFs that can deliver greater growth over time. Clear goals help you choose the right mix of investments and prevent emotional decisions based on market fluctuations. Step 3. Build an emergency fund. Before investing, you need financial stability. An emergency fund covering 3 to 6 months of living expenses ensures that unexpected events like medical emergencies or job loss don't force you to sell investments at a loss. For example, if you invested $1,000 in the stock market and then needed cash immediately due to an emergency, you could be forced to sell at a loss if the market dipped. An emergency fund protects your investments and provides peace of mind, allowing you to focus on long-term growth instead of short-term crises. Step 4. Pay off high-interest debt. High-interest debt is a silent wealth killer. Paying off credit cards or payday loans before investing is often the most effective investment you can make. For instance, carrying a 20% credit card debt while investing in a stock with a 7% return guarantees a net loss. And eliminating high-interest debt frees up cash flow and ensures your investments work for you rather than against you. Step 5. Start small with low-cost investments. Beginners should start with simple, low-cost investments. Index funds and ETFs are excellent because they provide diversified market exposure without requiring deep expertise. For instance, an S&P 500 index fund gives you ownership in hundreds of companies at once. ETFs work similarly, but are traded like stocks. These investments minimize risk, reduce fees, and allow you to participate in market growth steadily. Start small. Even $50 per month can grow significantly over time through compounding. Step 6. Open the right investment accounts. To begin investing, select accounts suited to your goals. Retirement accounts, 401k, IRA, a Roth, just ARA, tax advantages and long-term growth. Brokerage accounts, flexible options for stocks, ETFs, and mutual funds. Robo-advisors, automated portfolios tailored to your risk tolerance. Beginners may prefer starting with a Roth IRA or a low-cost brokerage account to gain hands-on experience without overcomplicating things. Step 7. Learn about risk and diversification. Risk is an inherent part of investing. Stocks can deliver high returns but are volatile. Bonds are safer but yield less. Diversifying your portfolio across multiple asset classes reduces overall risk. For example, a beginner could allocate 60% to stocks, 30% to bonds, and 10% to alternative investments like REITs or commodities. Diversification helps smooth out market fluctuations and protects your portfolio from single asset shocks. And step 8, consistency beats timing the market. Many beginners try to time the market, buying low and selling high, but this strategy rarely works long term. Consistent small investments over time, known as dollar cost averaging, are far more effective. Invest $100 monthly regardless of market conditions. Sometimes you buy at a high, sometimes at a low, But over time, your average cost balances out and your portfolio grows steadily. Consistency reduces stress and ensures long-term wealth accumulation. Step 9. Monitor, learn, and adjust. Investing is a learning journey. Beginners should track performance, review portfolio allocations, and learn from successes and mistakes. Avoid checking prices daily, as short-term fluctuations are normal. Focus on long-term growth, education, and understanding market trends. As you gain confidence, you can explore more complex strategies like dividend investing, sector-specific ETFs, or tax-efficient investing. Continuous learning ensures your investment decisions evolve as your financial knowledge grows. Step 10. Avoid common beginner mistakes. Mistakes can slow your growth. Avoid chasing trending stocks without research, selling during temporary market drops, ignoring fees and taxes, investing money you'll need soon, over-concentrating on a single stock or sector. Patience, research, and long-term thinking are your strongest allies as a beginner investor. Step 11. Increase investments gradually. As you learn and earn more, increase your investments. Start exploring new asset classes like international stocks, REITs, or high-quality bonds. Gradual increases compound over time, exponentially improving your financial position. Step 12. Stay patient and focused. Wealth doesn't appear overnight. The most successful investors are patient, disciplined, and resilient during downturns. Markets rise and fall, but long-term strategies consistently generate wealth. Staying focused on your goals, adjusting strategies as needed, and avoiding impulsive decisions are critical habits for success. Step 13. Consider professional guidance. If you feel overwhelmed, consider consulting a financial advisor or using a robo-advisor. They can help create a diversified portfolio aligned with your goals and risk tolerance. Beginner investors don't have to go it alone. Guidance can save time, reduce mistakes, and build confidence. Step 14. Take action today. The single most important step for beginners is starting. Even with limited knowledge, starting small and learning as you go is better than waiting for the perfect time. Time is your greatest ally. The earlier you start, the more your money grows through compounding. One of the most important concepts for beginner investors is compounding, earning returns not only on your initial investment, but also on the returns themselves. This principle is why starting early, even with small amounts, can create massive wealth over time. For example, if you invest $100 per month, starting at age 25 with an average annual return of 7%, by age 65, you could accumulate over $140,000. If you wait until 35 to start investing the same amount, you would end up with roughly $70,000. Time and consistency amplify growth far more than high-risk strategies or attempting to time the market. Compounding rewards, patience, consistency, and reinvestment of earnings. Step 16. Learn about tax-advantaged accounts. Taxes can significantly affect your investment returns if not planned for. Tax-advantaged accounts such as 401ks, IRAs, and Roth IRAs allow your investments to grow either tax-deferred or tax-free. 401k, contributions reduce taxable income, and earnings grow tax-deferred until withdrawal. Traditional IRA, similar to a 401k for self-directed accounts. Roth IRA, contributions are made with after-tax money, but withdrawals in retirement are tax-free. Start investing with confidence. Starting to invest with no experience may feel intimidating, but it is achievable with patience, discipline, and consistent action. Build a financial foundation, define your goals, start small with low-cost investments, and focus on long-term growth. Monitor your progress, diversify your portfolio, and gradually increase your knowledge and investment amounts. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.